and consequently, so would the policy response. So just to give you a sense of it, if we are looking at the numbers that, for example, we use for the US economy, and even China, by the way, has moved to quarter-on-quarter numbers. So let's say we were looking at trying to compare the path of the Indian economy to the path of the US economy. Then the comparable number in the Indian economy would be that in first quarter, on an annualized first quarter fiscal year, on an annualized basis, the economy declined by 93%. In the second quarter, which is the previous quarter, the economy increased by about 117%. And we haven't done the math for the quarterly part for this number, but my guess would be the economy recovered by about 20%. That is the path. There hasn't been any technical recession in India. There has been no recession in India. That there has been no 2 quarters of negative growth, because that is based on quarterly numbers, not on year-on-year numbers. So, and more importantly, as Rahul was trying to indicate, that is going to be difficult. This momentum in the economy of 20% in the third quarter is going to nosedive to about 6-7% in the first quarter and barely make it to 3-4% in the remainder of 2021-22. So the point being that instead of looking forward to a rising momentum in the economy, we now need to brace for a slowing momentum in the economy. But that's not where RBI is looking at. That's not where the government's policies are. And therefore, this bad information to me, is a problem, because that bad information is driving bad policies.
Okay, fair enough. How or where would you see the maximum weakness, as you pointed out, in the fourth quarter of the fiscal or the Jan to March quarter, just to make things easier? If you believe that this recovery pace will nosedive from here on, and that's a fairly strong word. And I'll come to policy prescriptions in just a bit, because there's also the global environment where the winds are turning slightly, in the last couple of weeks with what's happening with yields. So policy prescriptions later, but key areas of weakness that you think need to be dealt with in the subsequent quarter.
So let me just give you a growth profile. Suppose India's growth in level terms remains exactly where it is today in the fourth quarter growth number that came about. And we don't, in the level terms, GDP does not increase at all for the next 5 quarters. For the entirety of 21-22, we will get on a year-on-year basis a 10% growth rate. Any number that is less than 10% necessarily assumes that in the subsequent quarters in 21-22, on a quarterly basis, there will be quarters with negative growth. Without that, the arithmetic doesn't work. This is not economics. This is just pure arithmetic. If I keep it flat, then you get a 10% growth rate. So when I look at numbers that are going into government analysis or RBI analysis of growth in 21-22 is going to be 8%, 9%, and we are sort of feeling good about it. It actually implies that the momentum that these people have in the back of their minds is a momentum close to zero, that there is a complete flatness in the economy. So the issue is that why is it that is happening? Why do we expect that growth to be flat? Well, we expect growth to be flat, or the momentum to we expecting India to grow about 13.5-14% in 21-22. Again, it's pure arithmetic. There is nothing magic about it. With a mild increase in the momentum, not very much, but just a mild increase in momentum, particularly in the second half of the year. But the biggest concern is the following, that you cannot have, as Rahul pointed out, you cannot have income losses of that magnitude and not impair the ability of households and the ability of SMEs to access credit or to grow. Their balance sheets must have been terribly impaired. We know for a fact that listed companies did not suffer very much. In fact, in the previous quarter, RBI numbers suggested the listed companies' profit went up by 30%. Well, if listed companies' profit went by 30%, and that quarter, if you remember, the GDP fell by 7.5%, then the decline in the incomes of households and SMEs must have been more than 30%. I mean, again, it's just arithmetic. Right. With this kind of income losses, it is almost impossible for me to see how SMEs and households will be able to access credit, which is critical for their moving up joining in the recovery path. That's the concern that we have. So I think it is because because of that problem is that we think that the momentum is going to slow down. It's going to remain very sluggish until unless the government does something about the income losses and the impairment to the balance sheets of households and SMEs.
Okay, that's interesting because you're suggesting a shift towards a sort of a much larger fiscal stimulus. And I want to come back to that point because I know you've said that in conversations on BloombergQuint before, but I want to come back to that point in the context of what's going on right now in the world in just a bit. Rahul, you don't seem or sound so concerned about the underlying nature of this recovery. You want to talk to us about it? I just saw a report of yours drop in my inbox which says terra firma. So you're feeling a little bit more optimistic?
Yeah, so I think there is optimism, or there's reasons to be optimistic because, as Jahangir was saying, there has been a strengthening or almost like a forced clean out of balance sheets that has happened on the corporate sector, which has left them in a
Right.
better position. So there is possibility that some kind of a cyclical investment cycle could be undertaken by them, or at least the willingness or ability is there, which is better. But what also comes across clearly is that I think beyond a certain point, growth recovery needs private sector participation. And while the private sector impairments are probably lower than what was being feared about 6 months back, so there's reason to be optimistic. But then we are actually not predicting that much of growth. I think the CSO estimates of -8% look quite outlandish to me. I think we are
Okay.
probably going to be around -7% for the current fiscal, but for next year we are only penciling in 11% growth. So while there is recovery, there is going to be some parts of the economy doing well. I think it's worth remembering that the COVID crisis is not completely behind us. There is going to be pockets of spikes in cases, and so it is going to be a gradual recovery. But I would certainly think that the recovery is going to gain traction as the year progresses. So you are going to feel better about the sustainability of the recovery. But then I would completely agree with Jahangir's point that it's not, year on year numbers are going to be quite misleading over the next 6 months. We really have to look at the levels of activity more than the year on year growth rate. So the sequential
But Rahul, you're saying something slightly different from what Jahangir points out. He's saying if you look at the quarter-on-quarter numbers, he's anticipating a continuing slowing in the momentum of the recovery. Even use the word nosedive. But that doesn't seem to be the tonality that you're sharing.
Yeah, so I think the levels of activity will recover, and the mix of the activity will shift slightly from manufacturing and agriculture towards services. So this will be some amount of normality coming back in the way we all operate, or we all consume various goods and services. But then to get growth going again, right, beyond a certain threshold of activity, you need income growth to kick in, right? And for that you need job creation, you need some amount of more policy support. So I think Jahangir's point and my point are actually in sync, that that there needs to be a little bit of caution about the rate of growth, because that's going to be a mechanical thing. India's growth rates are going to be close to around 30% in the second quarter of this
Of course.
calendar year. But then beyond that, we are going to come back to earth. We are going to come back to levels of around 4 to 6%. At best we'll be at 6%. We might be as low as 4% depending on the external environment. And that is what I think is going to be the key critical factor, is what is the level of growth you are exiting this entire bounce in activity at. Are we going to be at 6% or 7%, or are we going to be closer to 4 5%?
And policy will determine that. And of course, I think we keep caveating to our viewers that please remember the base effect, whether you're looking at corporate earnings or you're looking at GDP economic data. If I can get into the weeds of the numbers in a quick couple of follow-up questions with you, Rahul. Most of the capital spending recovery, which has been pleasant to see in Q3, is predominantly government-led, and will it sustain into Q4?
Yeah, so my sense is there is a lot of government support in the capex numbers, the growth numbers that we have seen, although we don't really break up the data like several other countries do to separate out private and public capex. I think there is going to be support, and the budget clearly had in their spending plans, quite a bit of shift from welfare to capex spending. But then we also have to be mindful of the fact that it can have a negative impact on private consumption as well, because through the last 6 7 months, the government's private transfers, the food transfers, the cash transfers, they have probably helped in mitigating a lot of negative consumption effect. So maybe there's a case to be made that private consumption possibly weakens sequentially, but then capex spending will hopefully offset, given that they tend to have higher multipliers.
In the fourth quarter itself, as early as the fourth quarter, capex spending support?
I think so. I think in the fourth quarter, we should have another positive capex number, a capex growth number. We think growth will be closer to around 2.5 to 3% in the fourth quarter of the fiscal, and then you are probably going to see a very large increase in growth rate, closer to around 30%.
Okay, just a quick question on that Q4 number and the estimates for that. I was reading one report that suggested that if you look at the full year contraction revised estimate at -8, and the first 3 quarters for which the numbers are almost available, there's an implicit contraction estimated for Q4 in real terms, that is. Is that how you're calculating? Can you just give me an idea of how the overall headline number for Q4 looks like to you right now?
Yeah, so we absolutely agree with that. That if you just extrapolate the fourth quarter numbers out, you're going to have basically a -0.8% contraction, which looks highly unlikely, given that we had a week of lockdown in March last year, which should basically push up the entire base slightly higher. So my sense is we'll be around 2.5 to 3% growth in the fourth quarter of the fiscal. That should be enough to take us to around -7%. So I think the CSO estimates look to be a bit outdated in the current.
So you mean that the CSO's building in a lot more pessimism into its -8% estimate for FY21? Than yours itself, and you're in fact expecting growth in the fourth quarter, not a contraction which is implicit in today's numbers.
That's right, absolutely.
Okay, cool. Jahangir, can I come back to you on the fact that we now know that the wound inflicted in Q1, which was the April, May, June data, was much deeper than we had anticipated, which is why they've revised the full year number to an even sharper contraction of 8%. We're working, and like you pointed out, the policy resolutions haven't necessarily addressed all of those areas. Your fear is that the momentum will continue weakening from here on. How do you assess what the government should be doing here on?
Look, I mean, I'm going to sound like a broken record, as you pointed out. Look, I mean, there is nothing special about India. There is no Indian exceptionalism. India got hit by the pandemic like every other country in the world. If you look around the world and see what has been the thrust of fiscal support or monetary policy support, let's talk about fiscal first. We can talk about monetary later. What has been the thrust of the fiscal support, whether you're looking at the US, whether you're looking at Euro area, whether you're looking at Brazil, any of these countries, except for China. China is the only country that did not go down this path, but every other country, the bulk of the fiscal support is income support. Even right now, as we speak, the House in the US, the Congress in the US is debating about a $1.9 trillion of fiscal stimulus. All of that is income support in various forms. There's no talk about infrastructure spending. All of that is going to come much later in the US economy. If you go and look at Brazil's spending, even as late as last week, it is all income support. So there's a reason why these countries are doing that. And they're doing that because the biggest impact that the pandemic had is on income levels falling among the households, among those who are unemployed, and among the SMEs. They are the largest creators of jobs. So if in the recovery process, the largest creator of jobs, which happen to be the SMEs, do not have the balance sheet strength in order to access bank credit or even to participate in that recovery, then job creation is going to get pushed back. It doesn't really matter how many listed companies do what. It doesn't really matter whether infrastructure investment is increased. In fact, if you look at the budget, infrastructure increased by a measly 0.2% of GDP. There's not even any meaningful increase in infrastructure investment. Those are not the job creators. The job creators are the SMEs. And that is where the concern of everyone is, except in India. So it's Indian fiscal policy that doesn't seem to think that there is any need for income support. It is India's fiscal policy. If you look at the budget, there's not even a mention of the SME sector. There's not even mention of the income loss and the impairment to balance sheet. So the problem is that fiscal policy needs to shift and shift radically away from this obsession India has that we need to spend on infrastructure to something that Indians don't like doing, which is to provide income support. And
Jahangir, sorry to
we,
interrupt you there, but let me square that with a very present and current fear. May not be justified, you may not agree with it, but capital markets are definitely reflecting it, which is that of inflation on the back of at least the stimulus package size in the US and what that's doing to capital flows. So I think my question to you would be this: I know you disagree with the path that that the stimulus process in India has taken. Do you still think there's room, for a big shift? And or do you think that, in fact, the current environment where we're seeing yields rise make it incumbent for a shift away from monetary policy and liquidity-led measures to a more fiscal solution?
I'm actually not arguing for a more liquidity-led measure. In fact,
I get that.
that is the
But
point.
we're arguing for a shift
need,
away from it. I'm asking you about that.
yeah, I'm saying that the shift has to be on income support coming from the budget, not from liquidity measures that simply keeps on expanding the interbank liquidity and supports asset prices. That's not where the support has been. The support so far has been on the monetary policy front to push more and more liquidity to support asset prices. So I am asking for a shift, and the shift has to be that it has to be now the budget that needs to make real transfers to people's actual bank accounts, whether through mudra or whether through any other mechanism that we have in place, which we have many of them. Because if you don't do that, then the amount of savings that has been taking place in the household sector, the amount of saving that has been taking place in the SME sector, which doesn't get reflected in overall savings rates simply because the listed companies are saving much more by cutting down on employment and pushing back on investment, and is obscuring that. That amount of savings is going to come to haunt us in the second half of the year, the moment the debt moratorium is taken away by the RBI. And this time around, it is not going to be a handful of corporates who are going to be in default. There will be millions of people in default. And the political economy consequences of that is very, very different from the political consequences of 10 corporates being on default and going after them with the bankruptcy code, etc. You can't really use the bankruptcy code when millions of small households and SMEs go into default. And that is what we're looking at. Look at the RBI's own NPL numbers that they are looking at. They're looking at a very sharp increase in NPLs in the latter half of 2021 in the last financial stability report. So it's not just I'm saying that. Even the RBI is saying this. So I think that we are not looking at it as, it is not a question of putting more liquidity and money in the hands of people. We are putting in money in the hands of people who have used up their savings in order to survive the last 12 months. And they used up a lot of their assets. And that's where the problem is, that we are going to end up with SMEs and households will become asset poor in this recovery. And being asset poor means that you're not going to get any credit. No bank is going to start giving credit, especially under these circumstances with very low capital in the first place, to come to people who do not have the collateral. And if you're taking away the collateral, that is one of the biggest shocks of this pandemic.
Rahul, do you anticipate a shift in government policy from here on, versus what has already been stated in the budget?
Not really. I think the emphasis on infrastructure spending is very much going to be with us for a long time. I think, at least in my conversations with people in the government, I get a sense that they really see the multiplier effects of infra spending as being the most the most productive part of their entire push. I mean, I have a lot of sympathy for what Jahangir is saying about there being a lot of shifts, particularly across the across different stratas of the population and households who have gone through it has been a very different pandemic experience for different income levels, and that is going to probably have a huge impact in the way consumption recovers, and you are probably going to see a fair amount of stagnation, I think, both in consumption and credit disbursement in the next 12 months. So I'm particularly not as optimistic about a new investment cycle coming about, as has been talked about, quite a bit in the equity markets circle. So I would still say that, there is a fair amount of caution around the state of households. I think at an aggregate level, probably saving rates have gone up, because higher income households have been able to save more, and they do have the ability to consume. But then there is a political economy angle to it, which I completely agree with what Jahangir is saying. So I think, this is something, that maybe as more economic outcomes play out, as more data becomes apparent, there could be a possible shift around, the spending patterns. But I don't think in the current context, with the economy recovering the way it is, it is unlikely, I think, that there's going to be a big shift in the fiscal spending patterns, at least right now.
Okay, and how would you place that then, with the current context? And I'm only talking about the last couple of weeks, where we've definitely seen a hardening of yields across oceans, if I may put it that way. Look at what we saw with the currency today. All of that seems to suggest that policy responses need to become more adaptive over the course of the next 3 to 6 months, don't they?
I think, again, there is a fair amount of optimism that's been built in around the growth outlook. I think in the US, it probably makes sense because the kind of fiscal packages that are being discussed in the US, frankly, are very, very large, and they will have a big impact on spending and on growth. But then in case of India, I think, the fiscal policy support has been okay, but then you're not going to see the same kind of fiscal and monetary outturn. So I think the kind of rate hikes that are getting priced in, or at least on the Indian side, seems to be a bit outlandish. I think the RBI is not going to be in a position to hike rates aggressively, and any kind of normalization is going to be fairly calibrated and very, very gradual in nature. So my overall sense is that, maybe there's a bit of front running and a lot of optimism being baked in. I think this is almost a 180-degree turn to where we were about 6 months back when we got the first quarter fiscal year numbers, when it came at minus 20, 23% or 24%, and everyone went, okay, there's going to be a double-digit contraction. I think, for India, you have to take a bit of a more balanced view, that you're not going to have very optimistic or very pessimistic outcomes, and that's why we are optimistic that things are looking okay, but then we are not really anticipating a very, very large and sustained bounce in activity as well, which will basically mean that the RBI is not going to be hiking very aggressively anytime soon.
Okay, fine. Jahangir, then the last theme that I want to put to you as well. You've made your displeasure with India's fiscal policy evident, not just in this conversation, but in previous conversations as well. How are we placed today, given that there will be some constraints or further constraints even on the RBI to be able to respond to help support the economy in any fashion? And at this point in time, we're also maybe even seeing concerns around capital flows.
Look, we have prided ourselves for decades that, we are a closed economy and that things outside in the world doesn't really affect us because we have these marvelous capital controls. Even though from the GFC to taper tantrum to the last 3 weeks, it has been proven that every time the global market even shrugs, sneezes, India catches a cold. You have the 5-year rate in the US moving about 35, 40 basis points. Look at the 5-year rate in India has moved about 60, 70 basis points. And this is despite, the amount of bond purchases that the RBI has done at the back end of the curve at the 10-year rate. They still haven't managed to keep the yield curve from steepening. And the point being, steepening more than the US curve, yield steepening. So I think that the RBI needs to recognize that India is far more open than it tends to believe. Capital controls, etc., work, but there are enough amount of linkages for India to be almost immediately affected by what happens in the global front. So this idea that RBI has, that it can run multiple objectives, so it can target the bond yields because it's the government's manager of its debt. It can target the exchange rate. It can target inflation rate. It can target growth rate, and 17 million other things that you want to add to it. It can't do it. It just doesn't have enough instruments to do these things, and it has to choose and choose wisely. So if you look at the amount of interbank liquidity at this point in time, it's close to what, 9 trillion rupees, which is about 5.5, 6% of deposits. Normally the interbank liquidity is about 1-2%. So let's say some of that will go away because cash in demand was going to rise. And then, more or less that will be completely offset by the promised bond purchases that the RBI has already said it would do in 21-22, which is about 3 trillion rupees. That sort of washes out. So we will be living with 5, 6, 7 percentage points of GDP of deposits sloshing around in the interbank market. And if there is a threat to inflation, that's the threat to inflation. Now, suppose you get, $10 billion of inflows coming in and the RBI wants to intervene that. That's roughly about 750 billion rupees being added almost instantly to that pool of liquidity. So it cannot do what it's planning to do, which is, keep rates down, by buying more and at the same time intervene to keep the rupee stable at the same, because all of that points to a larger and larger increase in the interbank liquidity, which is the key threat to both asset price inflation and inflation per se. So if anything, the problem with the fears of inflation that the market has, they need to look at the interbank liquidity, and RBI has to abandon one of the two things. Either it stops supporting the bond yields, or it stops defending the rupee. One of the two things have to happen.
Well, we did see, we did see a sharp move on the rupee today, especially given in a single trading session. But what you're saying suggests that, in fact, if there are any capital outflows on account of a risk-averse approach to emerging markets, that might in fact give the RBI some reprieve, right?
Oh, RBI will heave a big sigh of relief if somebody helps them out with some capital outflows at this point in time.
And so what does that mean for the broader support? So you think that in itself will resolve the tension right now with regards to yields and help RBI keep yields lower for a longer period of time?
No, I mean, if capital flow outflows go, there'll be even more further pressures on yields going up, right? And if yields keep going up, then the RBI will be forced to intervene even more in the bond market. So I think that doesn't help them in terms of keeping yields down. It has to pay a cost somewhere. And the cost would be that the pressure on the currency is off in terms of appreciation pressure, but that takes away some of the liquidity in the system. Some of the liquidity in the system going away essentially implies that yields will be going up. So it has to give up, as I said, it has to give up something in this equation. Either it gives up the FX, or it gives up the 10-year rate, or it gives up inflation. It cannot say I'm going to do inflation, FX, as well as the 10-year rate simultaneously, because it's not possible.
Okay, you're very joyful to talk to on a Friday evening. You just pointed out that we're going to have a slowing momentum to the recovery, and that we're probably in for, whether we like it or not, some hardening of yields. I'm going to try and end with Rahul. No, sorry, go ahead.
No, but I'm saying that people are going to feel very, very, very good, because the year-on-year growth numbers are going to look spectacular. No, and so we will look at the year-on-year growth numbers, pat ourselves in the back and say, look at the momentum in the economy. That's not how momentum is defined in any other part of the world.
I'm not arguing with you. I'm just trying to end on a slightly more cheerful note, if nothing, just because it's a Friday evening. Rahul, slowing momentum of growth, you said you don't agree with that. You think that the RBI will succeed in keeping yields where they are right now?
So I think with the current account normalizing to a small deficit, and if you are having capital outflows, I think the way I would read it is that the degrees of freedom that the RBI enjoys on doing OMOs actually increases, because the net addition to liquidity in the last 1 year actually has been very overwhelmingly coming from foreign assets. So the FX reserve growth is what has been driving this liquidity pile up. Not that RBI has not been buying bonds, but actually a lot of money that was parked through the LTROs, the TLTROs has come back, because cost of funding has become even cheaper for a lot of corporates, who are accessing that window. So I think the RBI, almost in a cheeky manner, will be welcoming this capital outflow bout, and their degrees of freedom or their operational flexibility should increase in the near term. But in the medium term, I think what Jahangir is saying is absolutely correct, that the problem for the Reserve Bank has been that they have too many objectives that they have to meet, of keeping liquidity in a tight range. They want to keep yields low. They don't want short-end yields to be very, very low. They want the currency to be not appreciating. So it's too many objectives with too little variables to play with.
All right, y'all are both joyless people. Thank you very much for joining us with deep insights on the GDP data this Friday evening. Rahul, Jahangir, thanks very much for your time on BloombergQuint.
Thank you.
Bye.